Thank you for watching the Housing Oregon YouTube channel. Please like and subscribe. Slide decks from the presenters are going to be available below. Thanks for watching.
Good afternoon, everyone. Everyone who's here, thank you guys for sticking around. I know that this is towards the end of the last day, and I know some of you might have traveled in from outside of the Portland area, so really grateful that you are here. My name is Fred Griefer. I'm the director of the Santa Ana Homeownership Center, and really excited to be able to present to you Demystifying FHA. So this is a product of years of work and years of 24 layers of approval to get this out here. And basically, a lot of it is a product of what we've heard from you all and what we've heard from external stakeholders on, questions that they had about FHA, misconceptions. And for us, this is part of an ongoing effort for us to provide outreach and dispel myths, common misconceptions, and work to be able to do what we can to help provide insight to you all, so you provide that insight to those that might be interested in purchasing their first home and might not know, the process in doing so, and might have different ideas of it. And so when it comes to this presentation, we look forward not only to your participation in it, any questions you have, and anything that we could do to potentially build on top of this to further demystify our program and get more people educated in terms of the programs that we have. So at this time, I'd like to turn things over to Esther Yamashiro and Patricia Aguilar, the housing program officers for the Santa Ana Homeownership Center. And again, thank you so much for being here.
Thanks, Fred. Good afternoon, everybody. Again, thanks for coming. FHA turned 90 this year, and what may have been the case in the past may no longer be valid, or what you may have thought was required never was. So in any case, we hope we can replace myths with facts and help you grow your business using FHA. So this is our standard disclaimer. We're required to let you know that the presentation was vetted, but we are human. So if anything you see on the slides or we say contradicts anything in our published handbooks or mortgagee letters, the handbook and the mortgagee letter is always going to win. So just to clear that up. And the current version of our handbook was published on May 20th, 2024. So as Fred said, this creation was the work of our 4 homeownership centers, and they're split up like this across the country. So you deal in Oregon, so you're gonna deal with our homeownership for all things single family. Okay, so just to let you know that a lot of work was put into this program. A lot of the feedback was based on what we get from our partners out in the public. So why would anyone, a borrower, need or want an FHA mortgage? So FHA, I think, is primarily known before its flexible guidelines. The first one being, we have a lower minimum FICO requirement, and that's 580 for maximum financing. So what's maximum financing, you might ask? It's 96.5%. So the borrower is required to make a 3.5% down payment. Now, the borrower, actually, FHA will do loans for borrowers that have no credit score. So none of the borrowers on the loan have a credit score. They could still be eligible for FHA financing. So that's something to keep in the back of your mind if you have clients that fall into that bucket, okay? FHA also accepts gifts for 100% of the down payment and closing costs and prepaids of the loan. So they could literally get into the house with 0 funds of their own personal funds out of their pocket, okay? FHA is also not restricted to first-time home buyers, okay? because we do refinances and we do cash outs to 80. So if you have past clients that are looking to access their equity, this may be a vehicle for them. Now, FHA also allows secondary financing, and a lot of the down payment assistance programs that are out there that are provided by nonprofits and government entities are compatible with our mortgage as the first lien. So, and the one fact that you may not know is that FHA forward mortgage loans are fully assumable. So that means a borrower who got an FHA loan prior to the climb in interest rates and has that 2 3/4 30-year fixed rate mortgage, and now they have to sell their house for whatever reason. If they find the right buyer who's eligible and qualifies, that buyer could assume that 2 3/4% mortgage for the remaining life of the loan, which today with the mortgage rates still in the 6s, although we're hoping, we don't know, we're hoping they keep dropping, right? I think everybody is. That's still a possibility. So those are some things to keep in mind when you're talking to your clients. Skip a slide? Yeah, we skipped a slide. Okay, just really quick, going over what kind of loans we do. We have, again, our regular forward purchase money mortgages. Again, we're not restricted to first-time home buyers. We also have a rehabilitation mortgage, which is our 203K. There's a standard and a limited program. We'll go into the details a little bit later in the presentation. We also have a loan targeted for people who lost their homes in presidentially declared major disaster areas. Again, we'll give you more details on these programs as later on in the presentation. We also do energy efficient mortgages, and we do loans for solar and wind technologies. So our first myth, it's an MIP myth, which is mortgage insurance. So FHA mortgage insurance premiums paid by the borrower will make the mortgage payments in case of illness or loss of income. What do you think? Okay, the MIP, which is the mortgage insurance the borrower pays on the loan, is not homeowner mortgage protection insurance. It's not going to make the mortgage payment for your borrower. Okay, the premiums for mortgage insurance on an FHA loan is protects the lender against potential foreclosure losses. But that means that the borrower's loans are underwritten to our flexible guidance. And that's the trade-off that the lender makes in order to get our insurance, which is for 100% of their losses. Sorry, FHA sales commissions are lower than other mortgage types. So FHA does not regulate commissions. That's fully negotiable between the parties. And you know that we just changed. We're in that season of the NAR settlement regulations just went into effect. So all of that is negotiated between the parties, and FHA has no say in that portion. So this is a really common myth out in the industry that FHA loans take longer to close. And I'm here to tell you that the steps to close an FHA loan are similar to that of a conventional mortgage, and there really is no reason why it should take longer, generally speaking. So this is another common myth out in the industry that sellers shouldn't accept FHA offers because the deals occasionally fall through. So there's no reason why an FHA loan would fall through any more often than a conventional loan or a VA loan or a USDA loan. So, but again, that is a very common myth in the industry. Okay, so this myth is many mortgage companies do not originate FHA insured loans. And there are thousands of FHA approved lenders and third-party originators that will do FHA loans. Lenders have to be approved to participate and originate mortgages using with FHA. And this is a picture moment for you. That QR code will take you to a search engine on our HUD.gov website that you can search out the approved lenders in the area. And it's going backwards. I can't get an FHA insured loan because I live in a high cost area. This is another picture moment for that QR code. So FHA loan limits vary by county. Okay, they're set annually, and they're based on the median sales price in that particular county. Now we're coming up on the time of year where we will announce the new loan limits for the upcoming calendar year. Okay, so that usually comes out at the end of November or early December. We will issue a mortgagee letter announcing what those new limits are. So I make too much money to get an FHA insured loan. FHA has no income limits. And I know exactly where this myth comes from because a lot of the down payment assistance programs that are out there, those programs have income limits, which they are required to abide by. So that's what you have to check. If the borrower is using any type of down payment assistance money from a nonprofit or a government entity, you'll have to make sure that their income is under what the limits are. But FHA itself does not have an income limit. So only first-time homebuyers can qualify for a loan with FHA. And the answer is no. FHA is not restricted to first-time homebuyers. Now, the majority of our borrowers are first-time homebuyers because of our flexible guidance. You know, borrowers trying to get into their first home, sometimes they need a little extra help. Down payment, gift money, their income streams, their FICO scores or lack of a FICO score. So, but we have no income restrictions. So I can't get an FHA insured loan because I have a bankruptcy or foreclosure. So FHA guidelines for eligibility after the bankruptcy, 2 years on a Chapter 7, 1 year on a Chapter 13 after 12 months. That's the 12 months payout they do in a timely manner. Okay, for foreclosure, it's generally 3 years. So an easy way to remember that is 1, 2, 3. 1 year for a Chapter 13, 2 years for a Chapter 7, and 3 years for a foreclosure. And under foreclosure, that's going to count short sales, deed in lieu of foreclosure. All that's going to fall into that 3-year bucket. So my student loan debt will impact me getting an FHA insured loan. A lot of young people trying to get into their first home are worried about their student loans. So student loans, we're going to consider that as part of the borrower's liabilities in qualifying their mortgage. So let me go a little bit farther than that. Whatever payment is reported on the credit report for the borrower on their student loans, that's what we're going to use, except if it's 0. Okay. You can never qualify the borrower with a 0 payment. If there is not a payment reported on the credit report for their student loans or any type of loan, but for student loans particularly, we're going to use 0.5% of the outstanding balance of that student loan and count it against them as a debt. Okay, there's no qualifying with the 0 payment. Now that 0.5% is the same factor that Freddie Mac uses. Fannie Mae is still using 1% to qualify the borrower, so it's a little bit harder with Fannie Mae. So the buyers must have 3.5% of their own funds for their down payment. As I stated really quickly a few slides ago, FHA allows the entire down payment to come from a gift. And on top of the down payment, that gift can cover closing costs and prepaids. And it doesn't have to be a single gift. The borrower can get a gift from every relative or from whatever the acceptable source is, they can get one from every one of those sources in their acquaintance. If they're willing to gift them the money, they can use it to buy their house as long as the gift donor, whoever's giving their gift, meets our eligibility criteria. And that includes grants. Grants we consider in the same line as gifts. Okay. So total scorecard risk classification of accept is a guarantee of loan approval. Total scorecard is FHA's credit evaluation automated underwriting system. Okay, if you're familiar with Desktop Underwriter or Loan Prospector, which are Fannie Mae and Freddie Mac's automated underwriting service. Basically, all the data is uploaded into a system and it evaluates that and spits out a recommendation it's either acceptable or not. So FHA, their engine evaluates the credit and will either say it's accept or refer. And everybody wants an accept because that means you can move forward. But just having that accept is not the whole picture. We still require the lenders to validate the information that was submitted to Total Scorecard to make sure it's real and correct. Because the search engine can only evaluate the information as it's given. So if you can't document to support that information, then it's not valid. So just because they get an accept doesn't mean all their worries are over. Okay, the lender still has to validate that information. So now we're going to move on to property myths, which Patricia is going to review.
All right, so these are property myths that have existed, whether they're true or not, they've existed for a long time. And so we'll go over some of them. If you're not familiar with them, generally speaking, the myth is that there's a lot of restrictions on the types of properties that you can get FHA insurance on. And so we want to kind of dispel some of those myths. The first one is that FHA has too many repair requirements. So even just a few years ago, FHA did require, a lot more certifications and things like that. But now it's really up to the appraisal report. So if the appraiser sees a problem and reports it on the appraisal report, then then you might need some additional repair requirements and things like that. Our requirement is that the properties meet the property acceptability criteria, that all homes are safe, sound, and secure. This is to really protect the borrowers because a lot of FHA borrowers are using all of their funds, all of their savings to get into this home. And so if something goes wrong with the property, they don't have the liquidity or the funds to make those fix whatever problems come up. So that is one of our requirements. Another common myth out there is that FHA always requires repairs for missing handrails, holes in window screens, cracked window glass, and dripping faucets. These types of repairs are generally considered cosmetic or minor repairs. So if the property has these deficiencies and they're not considered to be a health and safety risk or a threat, they do not need to be fixed prior to closing. But the appraiser their responsibility is to report it and consider it in their overall condition rating of the property. This next myth is a lender may not waive any repairs reported by the appraiser. So if the appraiser sees an issue and reports it on the appraisal report, that's not necessarily the end of the story. So the lender ultimately decides which of those repairs have to be done prior to closing the loan, prior to insuring the property. And the appraisers have to limit their required repairs to things that maintain the health, safety, health and safety of the occupants. And, one of the other things that this, by making sure that the property is safe, sound, and secure, another thing it does for FHA, because we're insuring the lender and ultimately the collateral is the property. So we want to make sure that the property is still good. But regardless of the what the appraiser says on the report, it is ultimately the lender's decision. This is also related to the previous myths, but it's that FHA requires many property certifications. FHA inspection and certification requirements ensure that general property acceptability criteria are met, and it ensures that the collateral is good. But now, where before that, there were certain certifications that were required regardless. So for example, if there was well and septic on the property, it automatically required a certification. If the property had a flat roof, for example, that automatically required a roof certification. But now, unless the appraiser reports that there's an issue, maybe there's like a leak, water stain on the ceiling, so they want to see the roof certification, or if there's some sort of sewage issue or something, that's when they would require that certification. It's no longer automatically required. The next myth, we're kind of moving on from those repairs, and now we're going on to the different property types that FHA will provide mortgage insurance for. So the first is that loans are only given for single family homes. So FHA insured loans can be used to purchase single family, and in our definition, that means 1 to 4 units, homes, condos, modular homes, manufactured homes. They do have to meet certain FHA requirements, but we do generally do 1 to 4 units for different property types. We also do mixed use, which I'll go over in a little bit. Next myth is that an FHA insured loan can only cover the value of the home in its current condition. So FHA does have different programs that allow you to finance the cost of repairs and improvements, and then they'll use the appraised value with those improvements in there. So there's the 203K rehabilitation mortgage insurance program, energy efficient mortgage, and then the solar and wind and weatherization. The 203H, which is also listed here, can be used in combination with any of those other mortgage types. And I'll go over that 203H towards the end of the slides. We're going to go into the property improvement ones first. So there's 3 types of property improvement forward mortgages. So there's the 203K mortgage insurance program. That's our repair and rehabilitation mortgage. We also have the energy efficient mortgage, and that one requires an energy rater to come look at the energy improvements that can be made in your house, and it can be financed into your mortgage. And then the last one is weatherization. This is for like really minor repairs. Maybe it's like insulation or thermostats or whatnot, things that can be done within 30 days of closing your loan. So the myth out there is that I need cash on hand to renovate a fixer-upper. Sometimes that's the only thing that you could afford in your budget, or whatever. So this is a really important myth to dispel. And it's that we actually have a product that the 203K mortgage, rehabilitation mortgage, and that allows the borrowers to finance the cost of the repair, whether it's major or minor, into the purchase or refinance transaction. So it can be done at the time of purchase, or if at some point if you want to refinance your mortgage. So we are actually very excited about the recently published updates to the 203K program. These updates go into effect with case numbers assigned on or after November 4th. And we just want to promote the changes that we're implementing. So there's actually two types of 203K loans. There's the standard and then the limited. So for the limited program, it covers more minor repairs, nothing structural, like cosmetic things, floors, new kitchen, new bathroom, things like that. That financeable repair limit is now going from $35,000, which is the current limit today, to $75,000 in repairs as of November 4th. And this is the first time being updated in like 19 years. So it is a very long time coming, and it's probably the most anticipated change to this program. And then the second thing that has been updated is the construction time. The initial construction time, it was 6 months, and now we allow up to 9 months to finish these repairs. We understand with, supply chain issues, just unforeseen delays and things that happen, that we just wanted to relieve some of that stress from the borrowers. Then we have we also updated the number of days a borrower is unable to occupy a property during the rehabilitation period. So currently, with a limited 203K, because it's for minor repairs, they're only allowed to, not occupy the property for 15 days. We're increasing that to 30 days. Because it's supposed to be more minor repairs, we're expecting the borrowers to be able to live in their property while the work is being done. But it has been increased from 15 to 30 days. And then the last thing for the limited 203K that we've updated is the ability to finance the 203K consultant fee. So what's a 203K consultant? This is someone that you can hire if you're doing a limited 203K. On a standard 203K, it is required, but on a limited 203K, it is an option for the borrower. And this is somewhat like an expert that will kind of guide you through the 203K process, make sure that the work is being done, before the funds are distributed and things like that. So they are an important resource. And previously or currently, with the limited 203K, we did not allow that consultant fee to be financed, which we saw as like kind of an hardship for borrowers. A lot of borrowers never had experience with, fixing a house. So now we do allow them to finance that fee, even though it is an option. On the standard 203K end, we did not have as many updates, but we did increase the rehabilitation period from 6 months to 12 months. So now they can close the loan and they have 12 months to finish the work. And then we also increased the mortgage payment reserves from 6 months to 12 months. The mortgage payment reserves on a standard 203K is the amount that the lender can include in your loan amount to make your mortgage payments while this work is being done. This is assuming that you may not be able to live in your property for a while, especially if you're raising the property to its foundation, there's nowhere to live. And so you're going to have 2 house payments. So this mortgage payment reserve is meant to make those payments for you while you're unable to live in the house. So again, these system changes that policy and system changes that I just provided you go into effect for case numbers assigned November 4th. This is to allow us, the government, as well as the lenders, to be able to update their systems and their policies and things like that, and have everything ready to go at the same time. And then one last thing is that actually consultant fee structure was also updated, and that allows a more streamlined process to approve 203K consultants, and a higher fee structure, we want to increase the number of 203K consultants available to borrowers. We're going to move on to another myth. So we have FHA does not have any options for new construction loans. We actually have several options for newly constructed homes. There's the construction to permanent program, build on own land, and new construction. New construction is the type that we see the most often. It's where a builder or developer buys the property, builds the structure, and then sells to the borrower a final product. Construction to permanent and build on own land, that allows a borrower who may have a plot of land or may be purchasing a plot of land to build something on that property. Those programs are not used as often, I will say, but you can even put like a manufactured home or tiny home or even like a modular home on a plot of land. Whether it's going to be construction permanent or build on land kind of depends on whether that person owns that plot of land yet. So that's the main difference between those two programs. Next myth is regarding condos. FHA approved condo projects are run down. Same with any other property, FHA requires that condominiums are safe, sound, and secure, including the common areas. We also do require that the condo go through an approval process, whether it's a single unit approval or the entire condo project is being approved. And by doing so, we look at the financials, which we hope means that they're financially viable enough to make any repairs or whatnot. So that's kind of the little safety net we have there. The next myth is FHA does not accept mixed use properties. In a lot of like urban areas, we find that mixed use properties are getting more popular. So mixed use 1 to 4 unit single family properties may be eligible for FHA mortgage insurance. The main thing there is that the commercial components can't be used, included in the value of the property. And then the residential use must exceed the commercial use. So it has to be 51% residential. And then the commercial use can't pose a health and safety risk to the residential part of the property. Next, we have a hot topic across the country. FHA does not allow accessory dwelling units. That's the myth. And FHA does allow accessory dwelling units, but they do have to meet some FHA requirements as well as the local zoning requirements. Properties with accessory dwelling units have been acceptable for FHA financing for some time, as long as the ADU met our guidelines. But the big change last year came when we issued Mortgagee Letter 2317, and that established the guidance allowing the use of rental income on an ADU to help qualify the borrower. The next ADU myth is a below grade living unit is not an accessory dwelling unit. This is our definition of an ADU. An ADU must have its own kitchen, sleeping area, and bathroom facilities, and must have separate ingress and egress. And then it has to meet local zoning requirements. So even if it's in an attic or below ground, maybe in a basement, if it meets those requirements, it is considered an ADU for FHA. One thing I will add too is that we do allow FHAs on a 1 unit. So it would be a 1 unit with ADU. If you have a 2 unit property or a 3 unit property that also has an ADU, that will be considered a 3 and 4 unit property. So if you have a 4 unit property, that can no longer have an ADU because that would be considered 5 units for our definition. FHA will accept drive-by appraisals. This was a myth that kind of came from COVID and the pandemic. This exception was really made for social distancing and whatnot, but it's no longer valid. So FHA does not accept drive-by or exterior only appraisals. Next year, I'm going to go into that 203H program. This is for victims who lost their homes in a natural disaster. So this allows for the purchase or reconstruction of a single family property for victims that live in a presidentially declared major disaster area. that means that it has to have a presidential declaration, and you have to be able to find that in the FEMA website. So we go by that FEMA website. The perks of this program is that it allows a borrower or a buyer who lost their home in a presidentially declared disaster to relocate anywhere in the US. And it gives them 100% financing. So they don't have to have owned the home. They don't have to have had an FHA, existing FHA mortgage. They can still, even if they were renting, if the place that they were renting was destroyed, they can actually use this program. It's a really great program for, unfortunately, that we need to help, disaster victims who most likely lost everything in that disaster. The one caveat is that they have to apply for that new mortgage within 1 year of the of the disaster declaration. So whatever date that the president declared that disaster, that they have 1 year from that date. The last thing I want to go through before we go into our resources is our nonprofit programs. I understand a lot of people here are with nonprofits, government entities, and things like that. So I just wanted to, show you how you can use FHA programs for your organization. So FHA does have a nonprofit approval. Yeah, we have nonprofit programs that you do have to get approval for. We have 3 types of programs. So there's the HUD Homes program. This is where the nonprofits can purchase HUD real estate owned properties at a discount, and that during the exclusive listing period. Unfortunately, right now, we don't have that much inventory of HUD homes, which is not necessarily a bad thing because that means people aren't, doing distressed sales. But we do have that program. The second program we have is the FHA Mortgagor program. This allows a HUD-approved nonprofit or organization or government entity to apply for the same FHA insured financing as owner occupants. That means the nonprofit can purchase with 3.5% down and things like that. And that allows them to purchase a property and then use it for their affordable housing initiatives, whether they rent it out for affordable housing or they, decide to sell it at some point at a lower price for affordable housing. This allows them to take advantage of FHA financing for those nonprofits. The third kind is nonprofits approved to use to provide secondary financing. This is probably the most common out of the 3. It allows HUD-approved nonprofit organizations and government entities to provide secondary financing assistance to borrowers, home buyers that are using for FHA insurance on their first mortgage. If it is done in conjunction with a government entity, it can be used to provide the borrower 3.5% down payment on an FHA mortgage. If the nonprofit is not, part of a government entity and providing it themselves, it can be used to provide additional assistance. So the borrower still needs to come in with 3.5% down payment, but the nonprofit's secondary financing can be used for closing costs, prepaids. Maybe they want to buy down the interest rate, or maybe they want to increase their down payment amount to help them qualify. So in Oregon right now, there are only 3 HUD-approved nonprofits, and they're all for providing secondary financing. So, there's a lot of opportunity out there to become a HUD-approved nonprofit. If you are interested, come see us afterwards and we'll give you the information on how you can go about that process. Next, we have, just to close it out, we have our information for our resource center. The first is our website, HUD.gov/answers. This has a lot of a pretty good frequently asked question search database. You could search by topics. So if you are a nonprofit interested in getting approved, you can just put in how to approve nonprofits, and then you'll get all the little topics and articles on that. Go back. Oh, okay. Second is emails, and the third is telephone. That they will take you to the FHA Resource Center. Our resource centers are operated in our homeownership centers that we went over in the beginning, and they are real people and they will answer you as soon as possible, usually within 24 to 48 hours. So, you know, if you email them, they'll get back to you usually by email, or if you ask them to call you back, they'll call you back as well. So it is a great tool if you're, and our nonprofit approval team in our program support division is really, really great. And they'll like walk you through the entire process of getting approved. So again, it's a great resource. That's really it for our presentation today. If you have any questions, we're available to take them. We'll repeat the question on the mic.
Thank you for the site. There's a lot, obviously, a lot of I am curious, like, of all the policies you've covered, are any or all of them like potentially could they change with the presidential administration? Or
So the question is, you know, the policies and the FHA policies, whether they're subject to change with a administration, presidential administration change or whatnot. We generally find that the administration changes don't affect our policies as much. A lot of our requirements are in the Code of Federal Regulations, which means it takes an entire act of Congress to change. And so, and we are pretty insulated. I think it also helps that FHA is mostly self-funded. The mortgage insurance funds us. We don't really use taxpayer funds. So I think that kind of insulates us a little bit. Any other questions?
So the question is, are manufactured home regulations covered as part of FHA? Basically, is right. Right. So I'm going to call it a general manufactured home criteria. Okay. So, what it might help you to know is that the manufactured house regulations that govern the construction and construction standards for manufactured housing in our country are established by HUD. We have an office within the Department of Housing and Urban Development, which specifically tackles the manufactured home construction regulations. So we're the source of those requirements. So they have issued a lot of changes, and I think we can anticipate some more to come by, because it may be slow in coming, but we constantly review our guidance and regulations, and where we can make changes within our authority to make them better or revise them or modernize them. We do make that effort, and a lot goes into it. So I think you said it was for a multi-unit. it doesn't automatically translate. We take the construction standards are issued by the Office of Manufactured Housing. And then in the single family policy development division, they then develop policy around the eligibility and what the criteria involved in us being able to use those. So it may not happen immediately, but you will see it, I'm sure.
Okay, I have a question from the chat, and it was someone who was kind of dealing with overlays and things like that. So FHA provides, for example, 580 minimum FICO score requirement for 3.5% down payment. So those are FHA's minimum requirements. The lenders that you work with will sometimes have a stricter guideline, and we call those overlays. And so they may require more than what FHA requires. Not all lenders have those same requirements. So if one lender says that, at a 580 credit score, you need to go with manual underwriting, another lender might not say the same thing. So that's just something to keep in mind. The other question I think we got was something about interest rates. So FHA mortgage is a mortgage. So, it would have the same interest rate or whatever market interest rate. We do not set the interest rates. That's on, the lenders in the secondary market. So we don't set the interest rates, but the repayment terms are similar. So generally speaking, most people will get a 30-year fixed loan. So they'll have that fixed interest rate for 30 years. And I think the phone turned off. So I can't see the rest of the questions, but I think so those were the questions from the chat. Were there any more? Okay. Are there any more questions in here? Oh, the question was specific to the 203K program. The 203K program has the same requirements in terms of repayment as a regular FHA mortgage. So, if you're purchasing with a 203K, that means that you can also get the 3.5% down payment requirement. And the interest, the repayment on that would be 30 years from, whatever your first payment date is based on your closing date. Okay, let's show it. Yes. So one of our refinance programs, we do have a cash out refinance program. We also do have a streamline refinance program, which is, in the case that interest rates drop, which we're kind of hoping for, that a borrower can refinance out of their current interest rate to a lower interest rate without a FHA borrower. So they have to have an existing FHA loan, and they can refinance to a lower interest rate without having to pay for an appraisal. They just use that original value. Okay. The question is that on a 203K loan, does the consultant have to be certified by HUD? And the answer is yes. The consultant needs to get HUD approval. There's an approval process for that. We're hoping to increase the number of consultants available nationwide with our new guidance that we're rolling out. You can find that if you are searching for a consultant, you can go to our HUD.gov website, use a search bar, and look up 203K consultants.
So the question is does the 1978 lead hazard requirement apply? And the answer is yes. On a 203K, yes, it would still apply. Any other questions? I know it's the last session of the last day. So and knowing that, we really appreciate that you stuck around and you came because we thought maybe it would be an empty room. So we really appreciate you coming by. And we want to thank you all for coming. But if there are no more questions, safe travels to wherever home is, and we hope to see you again. Thank you.